Good morning, everybody. Happy Thursday. It's February 16th. Great to be with all of you today. My name is Bob Lang, and it's time for a Daily Bites. We do these every Monday and Thursday morning, usually about 8:30 in the morning. We're running a little bit late today because I had to kind of take a look at the economic data that came out this morning and kind of figure things out. And as you can see here, that PPI number came in extremely hot. Wow. I mean, big wow here. This is, let's take a look at that for a minute. You can see here from my screen that it looks like PPI month over month came in at 0.7. Expectation was for 0.4. So what you do is you annualize out that monthly number at 0.7 and you get out an 8.4. How do I come with that? Come up with that. You multiply 0.7 times 12, you get an 8.4% annualized rate. The Philly Fed Index, that was a disaster. Prices paid were up. The manufacturing index was down minus 24 on that reading versus an expectation of minus 7.4. We also see that jobless claims came down a little bit, so the jobs market remains tight. Core PPI came in at plus 5.4% year over year. We're looking for 4.9, and the month over month, 0.5, looking for a 0.3. And that was up over last month as well too. So all in all, this report just says that inflation is still here, it's still hot, and the Fed still has more work to do. I don't know if the market is going to accept the fact that that there's high inflation. I mean, we've known for the past couple of months, certainly since the beginning of January, that maybe the market is in denial that things are going the way they are. And you know, listen, you know what? The market is a liquidity-driven machine. When there's liquidity coming in to the markets, it's hard to fight that trend, right? Hard to fight that momentum. And if you've been trying to fight it for the past 6.5, 7 weeks, you've been losing because markets are up. But when you get data points like this today that share the sentiment that the Fed has been telling us all along, that inflation is hot and they have to keep on pressing higher. Well, you know what? I mean, you know, eventually the market is going to get religion, and maybe that starts today. So I think that you know, we have to be paying attention to levels now on the S&P 500, and as you can see here, the S&P looks to be opening down about roughly 45 handles or so. The Dow down about 250, 300. NASDAQ down 180. As well. So, you know, we're going to see some weakness at the start of the day. We'll see how it happens. So the last couple of times we've had some weakness like this, it was bought up with a nice bid. But right now we're seeing the VIX, as you can see down here in the bottom left-hand corner, is rising sharply. It's up about 8% today, with the VIX futures also up over 20%. So let me show you a chart of the VIX here as well. You know, when it gets down like this, down low like this, it's been down sharply for 3 days in a row, from 22 all the way down to roughly 18 and a quarter. You know, that's a danger sign, right? When we've had some of these steep drops like this, and we reverse right back up. Now, we didn't tag the lower Bollinger Band. That would be a sign that put sellers were going to be coming in on the VIX. If you're selling puts on the VIX or the volatility index, you're looking for the VIX to rise. You want to sell puts now and then buy them back later when they go up. It's kind of the opposite of what the markets are doing. So you're looking for a rise in volatility when you're selling puts. We're probably going to get some of that happening here. It probably happened over the last couple of days, and those guys are getting killed. But now they're going to get some of that money back, especially if we get a move over 20% as well too. I did read an article yesterday. Leanne shared with me something as well too, and I think she did. And Marko Kolanovic came out and said yesterday that you know, he thought that these 0 DTE or 0 days to expiration option players is kind of akin to what happened in the Volmageddon back in 2018. I did mention that a couple of different times in the chat room and in another video that I did. So it does seem similar to what's going on over there. It just seems like a lot of people are very bold and emboldened in their strategy here. But there's going to be a day of reckoning, a day when this thing blows up in people's face. So if you throw caution into the wind and you don't pay attention to risk, you're going to be in big trouble eventually, sometime down the road. I don't know when it's going to happen, but it's going to happen, and some of these people are not going to be able to get out of their positions, and it's going to be a real huge dislocation in the markets. It could be a day or a few days or a week or something like that, where we get some really weird action, weird activity, where these people just can't get out. So let's get back to the markets over here. So the S&P 500. Listen, you know what? If you want to be bearish, if you want to believe that the markets are going to go down, you have to have a valid case for it to happen, right? And all I'm going to tell you right now is that this market is in a nice uptrend channel, right? There's no denying that, right? It's been trading with higher highs and higher lows, and we went through that, blasted right through that December high with some vigor a couple of weeks ago, and we've just been kind of consolidating in that area. Now, what happens today, we really don't know. If we come back down and test the 20-day moving average, that's coming in at about 40.78. That puts us back down below 4,100 and in a range. Look, we had last week we had a big, huge down day on Thursday and bounced right back off the lower end of the channel. Now we're on the kind of lower end of the channel here as well. Right now we've kind of gone sideways for the past 3 days, roughly. And we were up on Monday, and then kind of going sideways the last couple of days. But it's going to be an interesting and important test over here, because we do have this 50-day moving average far down from where we're at right now. Let's call it 39.72. Now it is rising, and it did cross above that 200-day moving average. So we did have that quote unquote golden cross just a couple of weigts ago at the beginning of February. But tomorrow is expiration day. There's a lot of options that are going to be going off the board tomorrow. There's some heavy gamma weightings as well too. So we'll have to see how things unfold today. And again, with volatility up right here, the strategy recently has been, when volatility has gone up, is to sell that volatility, similar to what we saw prior to that Volmageddon. It's just, not anybody really believing that the markets can ever sell off ever again. And I think a lot of volatility sellers are trying to force the bear market to be over, and I think that's a mistake. You don't force the market to do anything. You just basically adapt to what's going on. But you know what? We'll see what happens here. I think the Fed funds futures, Fed Watch, has been updated now after 20 minutes. And yes, sure enough, we've got now a 12% chance of a 50 basis point rate hike at the next meeting, which is in March 22nd. So look at that. Currently 4.5. We've got a 12% chance, 88% chance of one rate hike. So pretty much one rate hike at least is baked in. Then we got to May, and we have a 71% chance of getting up to there, and then a 12% chance of another rate hike up here. So basically between now and May, there's about a 12% chance of 3 rate hikes, 75 basis points. Now we go out a little bit further, and you can see that 6% is starting to get priced in all the way down over here to the right-hand side. It's very small, but still you have to acknowledge that it's there. People are making a bet on 6% Fed funds rate. And we've noticed, certainly in the chart of the 10-year and the 2-year yield, that yields are continuing to climb. Let's take a look at that 10-year yield here. Look at that. We're almost to the December high level of about 3.9%. We might get up there a little bit later on this morning. So just pay attention to what's going on with the markets over here. And again, keep some protection on. I told everybody, I kind of looked like a fool yesterday and on Tuesday, telling everybody, and I think a lot of people were telling me, weren't telling me that, we're probably thinking that, Bob, you're an idiot. Why are you buying puts? The market's going up every day. I get it. I understand. But the more you protect yourself, the more you have puts on, the clearer things become, and the ability to buy calls becomes much easier, right? I can have a lot of puts on. I can lose money on those puts, but it actually serves as my protection to say to myself, okay, I've got puts on. I can go out and buy some calls if I see some charts developing in a bullish way that I want to add some calls. So and that gives me some balance, right? I'm always have some puts on. So even if they're not working, and of course, they started working yesterday, and then they went off the rails. They started working on Tuesday, same deal. They didn't. They ended up not working by the end of the day. But you know what? We got some volatility now in the markets, and maybe if that sticks here, people are interested in doing some selling. We'll have some big moves in some of these insights today. So, if you're not taking profits, if you're not moving money around on a regular basis, you're asking for to get your head handed to you at the end of the day. All right. And I'm going to say it without any uncertain terms. This is still a bear market. I repeat, this is still a bear market. Don't care what anybody else has to say. All right. We have not reached the level where we can definitively say we are now in a bull market. So we are in a bear market. A bear market, remember, my definition of a bull and a bear market, a bull market is one that goes up. A bear market is one that does not go up. Do you see the difference between up and down? Right? So a bear market could be one that goes sideways for a year, 2 or 5 years sideways. That will frustrate everybody, right? What if we end up with a 2% gain in the S&P 500 this year, or a minus 2% gain this year, right? We could have had a lot of volatility. We could have been up 5, down 5, right? We certainly had a lot more volatility last year, and then the year before as well too, when we were up strong in 2021. But what if the markets just go sideways there? That is indicative of a bear market. A bear market is out there to frustrate you, frustrate everybody, right? And if you're frustrated, then the bear market is alive and the bear market is winning, right? I don't know when this bear market's going to be over. It'll be over someday, but I'll tell you this. I've never seen a bear market end when the Fed is continually raising interest rates, or they're at a level where they're at right now. Okay, bear markets don't end with the Fed funds rate at 5% or 6%. Okay, this bear market started with rates at 0, and now we're up near 5%. Remember something: the Fed started raising interest rates in March of 2022. So even a year ago today, interest rates were what? 0. So we have to acknowledge the fact that the Fed is going to continue to be aggressive, right? And we have to play defense sometimes. The last few weeks, great to play offense, great to play some of these momentum trends and so forth. But if you're playing the junk, you're playing the things that may be working in the short term, and you're not taking profits, shame on you. All right, that's the name of the game. Taking profits off the table. You don't sit there and say, "Oh, I'm going to buy the stock at 11 and watch it go to 100." What are you, crazy? No, you don't do that. What you do is you buy it at 11, you sell it at 14 or 15, and say, "Thank you very much, Mr. Market. That was great. Moving on to the next one." All right. Hopefully that helps. And I won't be here for Daily Bites next week. Of course, Monday's a holiday. We have a 3-day weekend coming up. Really great. I think we all need another 3-day weekend. President's Day on Monday. I'm going to California tomorrow, and I'll be there for about almost 2 weeks. But we'll try to be back with the Bites. Won't be on Thursday, but I'll probably be back the following Monday, which would be the 27th. But if you've been paying attention on Twitter and so forth, I'm doing something called a market blast every single day. You guys have a chance to read my thoughts on the market action from the prior day and for that same day. It's a little bit more of a it's not a video portion, but it's a written portion of what I think about the action for that particular for the next day. I put it out already this morning. It's out on Twitter and on other social media areas, and should be in your email box if you're a newsletter subscriber. So take a look at that read. I'm going to try and post those every day from now going forward and all next week. So I'll see you guys back. Hopefully, I'll be in California on the 27th, doing the Bites at 5:30 in the morning on that day, and then I'll be back home on the 2nd, and probably going to be doing one a little bit later on in the day. In fact, you know what I may do is on the 27th. I may do the Daily Bites a little bit later on after the market opens. So we'll see possibly do that. So anyway, have a great day. Have a great long weekend, everybody. Thanks for listening, and hopefully we'll get some good trading ideas and opportunities here today. And as the song says, market just keeps spinning us around and around like a top, right? So play it safe. Don't do anything big. Don't do anything stupid. Just play with what the market is giving you now. Keep a lot of cash. Have some protection. Use that bear playbook, and I'll see you guys in a week and a half. Thanks.